Welcome to Section 5 of the ASC 718 SBC training series. We have built up the full conceptual framework for stock-based compensation accounting. Now, we apply it directly to the general ledger. This section covers all of the journal entries you will encounter across every SBC scenario, walks through 3 worked numerical examples from the handbook, explains how SBC is presented on each financial statement, details the required ASC 718 disclosures, and closes with the key differences between US GAAP and IFRS 2 that matter in practice. By the end of this section, you will be able to prepare the journal entries for equity-classified SBC expense recognition, option exercises, RSU vesting, share withholding for tax, forfeiture reversals, liability-classified awards, and deferred tax assets. You will understand how SBC is presented on the income statement, balance sheet, and cash flow statement. You will be able to trace through 3 worked examples to verify your calculations match the standard. You will know the full list of required ASC 718 disclosures, and you will understand the practical differences between US GAAP and IFRS 2, particularly on forfeitures and tax treatment. The core entry you will record every quarter for equity-classified awards is a debit to compensation expense and a credit to additional paid-in capital for stock-based compensation. The amount is the proportionate share of the total grant date fair value earned in the current period, calculated as grant date fair value times elapsed service divided by total vesting period, minus what you have already recognized in prior periods. The debit goes to the income statement line that matches where that employee's cash compensation would go: cost of goods sold for production staff, research and development for engineers, selling for sales, and general and administrative for corporate functions. No separate SBC expense line on the income statement unless the company specifically discloses it. When an employee exercises stock options, cash comes in at the exercise price. The cumulative SBC that was recognized for those specific options is also reclassified out of a PIC stock-based compensation. Together, the cash received and the accumulated SBC pool are credited to common stock at par value and to the regular additional paid-in capital account. The entry clears the SBC accumulated in a PIC SBC and converts it into paid-in capital that reflects the actual shares issued. The net result on stockholders' equity is unchanged by the reclassification within a PIC. Cash comes in, shares go out, and the APIC-SBC balance is transferred to the regular PIC account. When RSUs vest, the company delivers shares to the employee. No cash changes hands. Unlike an option exercise, there is no exercise price. The entry transfers the cumulative SBC balance in a PIC-SBC to common stock at par, and to regular PIC. Many RSU vesting events also involve a simultaneous tax withholding settlement. The company withholds a portion of the vesting shares, sells them, and remits the proceeds to the tax authority on behalf of the employee. That withholding adds a separate debit to a PIC-SBC and a credit to cash, reflecting the fact that the company has effectively repurchased shares at current market value to settle the employee's withholding obligation. 4 more entries complete the picture. A forfeiture reversal credits compensation expense, reducing the expense line, and debits a PIC-SBC to remove the balance that accumulated for that employee. For liability-classified awards, every quarter you debit compensation expense and credit the SBC liability account, increasing it to reflect the current remeasured fair value. When a cash-settled SAR is exercised, the liability goes to 0 and cash goes out. Debit the SBC liability, credit cash. For tax accounting, each period you record a deferred tax asset for the book SBC expense times the tax rate. Debit deferred tax asset, credit income tax expense. This credit reduces income tax expense in the current period. The company is receiving a future tax benefit, and it is recognized proportionally as SBC expense is accrued. The first worked example is a standard stock option grant. 100,000 options with an exercise price of $20, a grant date Black-Scholes fair value of $8.50 per option, cliff vesting after 4 years. Total grant date fair value is $850,000. Annual SBC expense is $850,000 divided by 4 years, $212,500 per year, every year for 4 years. Now in year 3, an employee forfeits 20,000 unvested options. The reversal amount is those 20,000 options times $8.50 times the fraction of the vesting period elapsed, 3/4, giving $127,500. That $127,500 is credited back to compensation expense in year 3. The remaining 80,000 options continue to vest over year 4. The second example is an RSU grant with quarterly vesting. 10,000 RSUs at a grant date stock price of $45 gives a total fair value of $450,000. Vesting is 25% per quarter over 4 quarters, so quarterly SBC expense is $112,500. At the end of Q1, 2,500 shares vest. The entry debits a PICSBC for $112,500 and credits common stock at par value, 2,500 shares times the par value per share. With the remainder going to regular a PIC, the entry simply converts the SBC balance that was accumulated in a PICSBC into actual shares issued. Notice that no new expense is recorded at the vesting event. The expense was all recognized in the prior quarter. Vesting is an equity reclassification, not an expense event. The third example shows the cumulative catch-up mechanics for a performance condition. 50,000 PSUs at $30 per share with a 3-year EBITDA target. In year 1, the team estimates 70% probability. Expense is 50,000 times $30 times 70% times 1/3, giving $350,000. In year 2, the estimate rises to 90%. The cumulative expense that should have been recognized through year 2 is 50,000 times $30 times 90% times 2/3, $900,000. Subtract the $350,000 already recognized, and year 2 expense is $550,000. In year 3, the EBITDA target is achieved. The remaining amount to reach the 100% cumulative total is $1,500,000 minus $900,000 already recognized, $600,000. Notice how the year 2 expense of $550,000 is larger than year 1 precisely, because both the higher probability and the catch-up are reflected in the same period. Presentation rules are specific and sometimes surprise teams who have not worked with SBC disclosures before. On the income statement, SBC expense is not a separate line unless the company specifically chooses to disclose it. It lives inside COGS, R&D, sales, or G&A alongside cash compensation. On the balance sheet, the cumulative SBC credits sit in a PICSBC until awards vest or are exercised, at which point they transfer to common stock and regular a PIC on the cash flow statement. SBC is non-cash and added back in operating activities. Option exercise proceeds come in as a financing inflow. Tax withholding payments on RSU vesting, where the company sells shares on behalf of the employee to cover taxes, are a financing outflow. Excess tax benefits, which we covered in Section 4, are reported in operating activities. ASC 718 requires some of the most detailed disclosures in US GAAP. Companies must describe all SBC plans, the types of awards, vesting conditions, and maximum option terms. The weighted average grant date fair value of awards granted during the period must be disclosed by award type. Total SBC expense recognized must be broken out by income statement line along with the related tax benefit. A full roll forward of outstanding options is required. Grants, exercises, forfeitures, expirations, and ending balance, with weighted average exercise prices and remaining contractual terms. The intrinsic value of options exercised and RSUs vested during the period must be disclosed. And critically, the total unrecognized compensation cost for unvested awards and the weighted average period over which it will be recognized must be stated. Investors use this unrecognized cost disclosure to project future expense. The Black-Scholes assumptions must be disclosed: volatility, expected term, risk-free rate, and dividend yield. ASC 718 and IFRS 2 share the same core principle and are broadly converged, but two practical differences matter. On forfeitures, US GAAP allows entities to choose between estimating forfeitures up front or recognizing them when they actually occur. IFRS 2 requires the estimate approach. There is no actual occurrence election. For companies converting from IFRS to US GAAP or comparing across jurisdictions, this creates potential differences in early period expense patterns for high turnover populations. On tax effects, US GAAP under a SU 2016-09 routes everything, excess benefits and shortfalls, through income tax expense. IFRS 2 routes the portion of the tax benefit that corresponds to the book expense through equity, with only the excess going through profit and loss. This means IFRS companies will show lower book income tax expense on the tax shortfall side, but also less P&L benefit on the excess side compared to US GAAP peers. We have now walked through every SBC journal entry, 3 worked examples to validate the numbers, financial statement presentation rules, and the full disclosure package required under a SC 718. The core entry is simple debit compensation expense, credit a SBC, but the complexity lies in getting the amount right through all the scenarios: performance condition updates, modification add-ons, forfeiture reversals, and tax accounting. The disclosure package is extensive and requires a dedicated roll forward and unrecognized cost schedule. And while IFRS 2 is broadly aligned with a SC 718, the forfeiture policy and tax treatment differences can create meaningful divergence in practice. In Section 6, we close the series with the controls, audit expectations, and period-end checklists that bring all of this technical knowledge into operational execution. Thank you for completing this section on journal entries, financials, and disclosures. Thank you for watching. Subscribe for more training from PNJ Group.